Welcome to the first edition of JAG Exchange. I'm James Sindelar, and with me today is our CEO and CIO, Norm Conley.
Glad to be here.
Thanks for joining. Today we're going to talk about, it's a hot topic. It comes up in conversations that I have every week, AI. And is it a bubble? Similar to the tech bubble, there's a lot of questions going around about, hey, is this lining up to be sort of a repeat of history? So Norm, what are you seeing? What are your thoughts on this? Is there anything that is similar or dissimilar?
Yeah, so first of all, nobody can know the answer for sure. You can only tell bubbles with hindsight. Our sense and my sense is that we are not in a bubble. In fact, this is probably the biggest technological revolution that I've seen, certainly in my career and probably my lifetime. And that means it's bigger than the dawn of the internet. It's going to have, I think, and we've written a lot about this, AI is going to have a profound impact on markets, which is where your question is centered, the economy, society, and it is a huge deal. In terms of differences, I've been lucky enough, if you can put it that way, to have invested through the dot-com era and afterwards. And there are some similarities in the sense that there are obviously a lot of stocks that are tied to the theme. Back then it was the internet. Now it's AI that have done quite well over the last 3 to 5 years. But there are probably more differences than there are similarities. So, thinking back to the late 90s into the March of 2000, which in hindsight is when the bubble burst, much of that boom was driven by debt. It was really a debt-fueled infrastructure build-out. When we were building out the internet, companies were correct that the internet was going to be huge, but they underestimated how long it would take to get to what we consider today the internet. And as part of that, they invested billions and billions of dollars in fiber optic cable and laid that cable. A lot of it was laid along railroad right-of-ways. That's just a kind of a part of the history. Once the bubble burst, there was a period of time in the early 2000s where 97% of all the fiber optic cable that had been laid was dark. It was called dark fiber. There have been several smart investors and pundits that have made this point over the last, say, 6 months, but there are no dark GPUs. There are no dark graphics processing units that are out there that are not being utilized. In fact, all of the real risk is under capacity or not having enough. So that's one difference. And then going back to how it's being financed, the vast majority of the investing that's going on now is funded by cash on balance sheets. It's not being fueled by debt. And usually when we see really big market calamities, debt is in the room somewhere in a big way. So that's probably the main difference.
In conversations we had before, there's still debt involved, but it seems like it's a lot with some of the smaller sort of players, as these giants that are investing just an absurd amount of capital.
The hyperscalers, which are the mega cap technology companies that are really driving the vast majority of the investment, are funding it with cash from their balance sheets, cash from operations. There's also a significant amount of venture capital that is by definition equity capital that is being spent and invested by companies like OpenAI and Anthropic and others. The fact that debt is a relatively small slice of the capital being employed here is, I think, a really important difference.
When was the last time that we've had this level of investment?
It's been a long time. In fact, most likely by the end, if things continue at their current pace, by the end of 2027 or at the latest 2028, this will have ended up being the largest private CapEx boom since World War II. So it is a very, very significant boom in capital spending. And it's probably driving, estimates vary, it's driving a material part of GDP growth in the United States here over the last 18 to 24 months. Stated another way, if we weren't investing so heavily or seeing such heavy investments in AI, economic growth would likely be much slower than we've seen here. Another difference between our current state of the markets and AI versus the dot-com era is market valuations, stock market valuations are just dramatically less expensive. Still not cheap. I wouldn't make the case that stocks are cheap, but compared to stocks at the end of 1999 or early 2000, the S&P 500 is 40% cheaper than it was back then. And so one could argue, and I guess I am making the argument, that the lack of extreme valuations or as extreme valuations as we saw in the dot-com era is another piece of potential evidence that we're not in a bubble.
That's great. Well, thank you for joining us today, Norm. Thanks for entertaining me a little bit, and we'll be back here with another segment shortly.